All right, let's get right into it. In today's explainer, we're going to unpack the exact math and, honestly, the incredibly realistic timelines to turn just $100 a week into a massive retirement nest egg. If you've ever felt like building wealth is this super exclusive club that requires complicated Wall Street maneuvering, well, prepare to have your mind completely changed. Today, we're breaking down the $100 weekly wealth blueprint.
Okay, let's dive into this. I want you to genuinely think for a second about what you usually do with $100. It is shockingly easy to spend, right? I mean, maybe it goes toward a really nice dinner out on a Friday night. Maybe it's a new pair of sneakers you got targeted for online. Or honestly, maybe it just magically disappears over a couple of quick grocery trips for snacks. $100 feels like a pretty insignificant amount of money in the grand scheme of our busy lives. But as we're about to see, how you treat this exact amount can completely, fundamentally alter your financial future.
It's kind of wild when you contrast these two paths. On one side, we have the temporary satisfaction of that dinner out. You know, it's fun, it's delicious, but by the very next morning, the value is just entirely gone. Now, on the other side, we have the concept of automated wealth. By simply shifting that $100 a week, which, by the way, comes out to about $400 a month into investments, you aren't trying to be rich today. You're building permanent financial security for tomorrow. It's really about a mindset shift, moving away from instant, fleeting gratification and stepping into automated, absolutely unstoppable wealth building.
And the real engine behind this unstoppable wealth is what Albert Einstein supposedly called the eighth wonder of the world: compound interest. Seriously, if you want to understand wealth, you absolutely have to understand compounding. It is the secret sauce of the financial world. It essentially means you aren't just earning interest on the money you initially put in. You're actually earning interest on your interest. It becomes this continuous, self-feeding cycle of growth that just accelerates the longer you leave it alone.
To really picture how this works, think of the snowball effect. Imagine you're standing right at the top of a massive snow-covered hill. You pack together a tiny handful of snow. That's your first $100. And you roll it down the hill. Now, at first, it just picks up a few flakes here and there, but as it keeps rolling, its surface area expands. It starts picking up more and more snow, moving faster and faster. By the time it finally reaches the bottom of the hill, that tiny little snowball you made is a massive, unstoppable boulder. That is exactly what compound interest does to your money over time. Eventually, your money is doing all the heavy lifting, not you.
But I know what you might be thinking. What if I invest my $100 and the stock market crashes? Honestly, it's a fair question. And this brings us to a beautiful strategy called dollar cost averaging, or DCA for short. Think of it kind of like going to your favorite clothing store. If you commit to investing exactly $100 every single week, regardless of what the news headlines say, you literally win either way. When the market is high, sure, your $100 buys fewer shares. But when the market dips or crashes, suddenly everything is on sale. Your fixed $100 automatically buys way more shares at a steep discount. Over time, this smooths out your average cost per share entirely in the background, making the whole process completely stress-free.
So let's actually map out this wealth journey chronologically. We're going to hit the 5, 10, 20, and 30-year marks. Now, to do this math fairly, we need a baseline. Historically, the U.S. stock market, specifically when we look at the S&P 500, has returned an average of about 10% per year over the last several decades. But just to be super safe, for this explainer, we're going to use a conservative return of about 8 to 10%, just to show you what is highly realistic without exaggerating the numbers.
Now, what's really interesting about this slide is the foundation this builds at just the 5-year mark. In 5 years, you've got 260 weeks. At $100 a week, your total out-of-pocket contribution is $26,000. But because of our good frame compound interest, assuming around a 9% return, your portfolio isn't just sitting at $26,000, it is organically grown to over $32,000. And honestly, beyond just the math, the psychological win here is massive. You've built a rock-solid automatic habit, and you now possess a growth and emergency fund that provides a level of financial security that, frankly, 90% of Americans simply do not have.
Let's fast forward a bit to the 10-year mark. This is where the snowball is really starting to gather some serious speed. Over 10 years, you've contributed $52,000 of your own hard-earned cash. But your portfolio value? That's jumped to between $84,000 and $86,000. I want you to look closely at that difference. The market literally just handed you over $32,000 in purely free money, simply for showing up and being consistent every single week. Your interest is now actually starting to rival the physical cash you're putting in.
But the 20-year mark, that is the true point of acceleration. Notice the massive gap expanding here.
Over 2 decades, your total invested capital straight from your paycheck is $104,000, but your account balance has absolutely skyrocketed to roughly $300,000. Your interest earned, which is over $190,000, is now almost double your actual out-of-pocket contribution. At this stage of the game, your money is working way harder than you are. It's basically putting in overtime while you're fast asleep.
And this brilliantly illustrates the ultimate payoff at the 30-year mark, genuine millionaire status. Over 30 years of quiet, frankly kind of boring discipline, you only sacrificed $156,000 out of your pocket. But your portfolio is now crossing that legendary $1 million threshold. Just let that reality sink in for a second. You provided $156K. The remaining balance, nearly $850,000, is pure, unadulterated compound interest, gifted to you courtesy of the growth of the broader U.S. economy. You literally became a millionaire on just $100 a week.
Now, we gotta keep it real here. To look at the full, honest picture, we have to talk about the inflation trap. $1 million sounds absolutely amazing today, but $1 million 30 years from now is not going to have the same buying power. Things just get more expensive. That's how economies work. And that's exactly why this isn't some shady get-rich-quick scheme. It's a foundational, long-term wealth strategy. If we ignore inflation, we aren't being totally honest about the whole picture.
Luckily, the fix for the inflation trap is super simple. First up is step-up investing. You really shouldn't just invest $100 a week for the rest of your natural life. As you get promoted, as your salary inevitably increases over the next decade or two, just bump that weekly transfer up. Make it $150, then maybe $200. Second, you have to ensure you are reinvesting your dividends. In the finance world, this is often called turning on DRIP, or a dividend reinvestment plan. When companies pay you a slice of their profits, which they do, don't cash it out to buy coffee, automatically use it to buy more shares. It puts your snowball on absolute steroids.
Okay, so how do we actually pull this off in real life? Here are the practical, totally foolproof steps to set this up right now. Step 1. Open a tax-advantaged account. If you're in the US, this means looking at a Roth IRA, where your money grows 100% tax-free for retirement, or a traditional 401k, especially if your employer offers a match. Seriously, an employer match is literal free money. Never leave that on the table. Step 2. Pick broad market index funds. And step 3, set up those automatic weekly transfers. Have it pull that $100 every Monday or Friday, right after your paycheck hits. Do it automatically so you remove human emotion from the equation entirely.
Let's zoom in on that second step for just a second. Where exactly does the money go once it's inside that account? Listen, you do not need to stress yourself out picking individual winning stocks, and you certainly don't need to gamble your future on highly volatile crypto. You just need to buy the whole market. Target simple, low-cost index funds or ETFs like VOO, SPY, or VTI. These funds automatically track the top 500 companies in the US or even the entire total stock market. By doing this, you're placing a very safe bet on the long-term success of the entire economy rather than trying to find a needle in a haystack.
So the crucial point is that building generational wealth is not about hitting it big on some viral stock trade you saw someone hyping up on social media, and it is definitely not about buying a lucky lottery ticket. It is entirely about boring, relentless consistency. It's about finding those minor money leaks in your monthly budget, the extra takeout you didn't really need, the 3 streaming subscriptions you haven't watched in months, and redirecting those funds into an automated machine that literally builds your future for you.
As we wrap up this explainer, I want to leave you with one final, totally honest thought to reflect on. What is truly stopping you from investing $100 this week? Is it an actual lack of funds, or is it just a financial habit that hasn't quite been built yet? The math is incredibly clear, and the blueprint is right here in front of you. The only thing left to do is actually take action. So take a hard look at your spending this week, find that $100, and start rolling your snowball today.